Welcome back. It's time for the big picture. Joining me now are Cooper Howard, Director and Fixed Income Strategist for the Schwab Center for Financial Research, and Liz Ann Sonders, Chief Investment Strategist for Charles Schwab. Good afternoon to both of you. Liz Ann, I'll start with you. First off, thanks for joining me. But it looks like the market got some good R&R over the weekend. Big bounce back in equities, big bounce back in treasuries, but also a huge bounce back in consumer confidence, I believe it was, from the conference board. What did you make of that data point? I think that was the surprise of the day.
It was, and I think what was particularly good within that report was the expectations component. So consumer confidence put out by the conference board has a headline confidence rating, but then there's two subcomponents that are widely watched as well. The present situation component and the expectations component, which is a 6-month lookout. That expectations component had the biggest drop in on a monthly basis in 4 years. Now, that said, part of the reason for the big move up was just how depressed that reading had been, down to levels akin to what we saw back in the global financial crisis. So I think it shouldn't have been too big a surprise to start to see a little bit of catch up in some of this so-called soft economic data because of just how depressed it's gotten. So that was the headline within that index that I think was most notable.
Almost would kind of clarify that it's more of a normalization than a real rebound, given the fact that the maybe super depressed levels weren't all that reflective of kind of reality on the ground. Is that kind of how you would, say, is what happened?
Yeah, I think we're seeing something similar to what we saw back in 2022 when we had the combination of the spike in inflation driven by the pandemic and the most aggressive tightening cycle in 40 years on the part of the Fed. We saw a huge compression in the soft data that ultimately wasn't corroborated by the hard data. Our view in this backdrop is one where most likely scenario is a little bit of convergence between the two, where you see a little bit of a lift up in that soft data because of just how supremely oppressed it has gotten, while at the same time you see a little bit of catch down on the part of the hard data. And that was certainly borne out by data like that we got today.
Cooper, we could also probably add as well that we're really seeing the uncertainty surrounding the trade policy has had a real influence on this data. Of course, this would have been surveyed after the 90-day pause and the rebound in the markets, and you see that subsequent almost V-bottom in this particular survey. What did you make of the data?
I think that's another good point about it, is that it is related to the tariff data, and there's a lot of volatility that's occurring with it. The consumer confidence numbers. And I think that's where kind of it's akin to the volatility that we're seeing in the Treasury market right now. Is the trade war on? Is it off? We got good news about the EU over the weekend, but ultimately we're seeing a lot of consumers begin to kind of pare back a little bit. And one of our themes, Alex, over the rest of the year in the Treasury market is that this volatility is likely to continue. So we do expect that, given kind of the uncertainty related to the trade war, how that's going to translate into Fed policy, that's going to create a lot of volatility in the Treasury yields. And ultimately what we're seeing today, I think, is just one of the signs of that coming to play.
Liz Ann, if we kind of take into account what Cooper is saying here and tie it back to equity markets, clearly today there's a lot of headlines and chatter around zero DTE flows and the buy the dip stuff. But on a more, let's say, medium term, if we're to expect increased Treasury volatility, I'm having trouble envisioning a less volatile equity market. Is there a world where Treasury volatility can kind of detach itself from equity volatility, or is that relationship going to exist?
I think that relationship is going to exist. And I think there's two facets of moves in Treasury yields that define whether the market digests moves like that well or not. It's, number one, the speed of the move. I think that was really what was unsettling in the early part of April, and arguably was the Trump put, what led the Trump administration to announce the 90-day delay on those so-called reciprocal tariffs, was just the speed of the move from sub 4% on the 10-year to 4.5% on the 10-year. I also think it's the why behind yield moves that matter. I think if yields were to reconnect with inflation, concerns on the upside, more benign backdrop on the downside, that would be a more sort of dire backdrop for the equity market. So it's a function of the why behind the moves as well as the speed and magnitude of the moves.
I totally agree with you on kind of the velocity of that. Really a turnaround too. I always think of it in price, but you saw a tremendous move higher in yields in April. When one would have maybe have thought a risk-off move was warranted, I think that definitely got the attention of many people in markets. But Cooper, I'll give you the last thought here. Tons of Fed talk. We get FOMC minutes this week. Seems like we just keep pushing the cuts out further and further. Is there going to be any real news headlines in your mind out of the Fed this week?
You know, I don't think that there's going to be any major market moving pieces of the Fed this week. Obviously, we get the minutes. I'm not expecting too much in terms of that, Alex. I think really what the playbook from the Fed has been is that they want to be patient with rate cuts. Now, our team does still believe that rate cuts are coming. We're betting on about 1 to 2 rate cuts this year. But again, that's going to be dependent upon where the labor market really comes into play. So if we see more of a softening in terms of the labor market, I would lean more towards the 2 rate cuts. But in terms of what to hear from the Fed this week, again, I'd be largely surprised if we hear anything. We've heard from a few speakers already, and really what they've been saying is that they're going to be patient to see how the economy develops. They feel that they've got the Fed funds rate at a pretty good level right now, and they just want to see what's going to come down the pipeline before making any significant moves.
You say patient, I say cagey. That's been the vibes I get from the Fed as of late, as they're just trying to figure out what's going on here, not give away too much. Liz Ann Sonders, Cooper Howard, thank you both so much for joining me here to kick off the week.